morning, sir. Welcome to the show. And let's talk about the loan growth. Loan growth has remained muted and was nearly flat sequentially. What factors constrained growth over here in Q1, and when do you expect growth to re-accelerate from here?
Well, if you look at it on a sequential basis, yes, you are comparing the March quarter with the June quarter, and you are very well aware that the March quarter, being the last quarter of the financial year, is always a big quarter for all companies, whether in the financial front or other fronts. The June quarter, being the first quarter of the year, is slightly subdued, but it has not been the case in our case. If you look at it on a year-to-year basis, our disbursements have grown by 14.5%. Last year in the first quarter, they were 13,116 crores. And this year in the first quarter, we have churned out 15,014 crores. So 14.5% disbursement growth year to year, I believe, is a very good growth. And I think this is a trend which can be continued in the near future if all things remain the same they are, if the market conditions remain the same. So I would not say that the disbursement growth has been muted. Or rather, I would say that the disbursement growth on a year-to-year basis has increased significantly by 14.5%.
Right. Mr. Adhikari, also, are you confident of guided loan book growth in FY27 of about, say, 10 to 12% or thereabouts?
Yes, the way it is going right now, we are very much confident of attaining our guided value of 10 to 12% growth. We had guided for 15% in the first quarter of this year. We have ended at 14.5, which is almost as close to the guided path as possible. For the second quarter also, I believe we would guide at somewhere around about a 15% growth in the second quarter also, year on year. And I believe that would give us a very good stepping stone to achieving 10 to 12% guided growth for the year.
Sure. Now, given the combination of slower growth and margin pressure, what are the key levers to improve earnings growth over the medium term?
Well, one thing which we are trying is product diversification. So we are heavily inclined towards IHL, that is individual home loans, which constitutes almost about 85% of my book. And out of IHL also, if I further segmentize it, about near about 83% is salaried customers, right? Quite natural, this being the prime segment of customers, there is a big competition or a war which we are fighting with banks, because these customers are also customers of banks. So we are trying to diversify on this. It is going to take time. It is not going to happen overnight. We are very well aware of that. And but we see, definitely we see green shoots. We see diversification strategy over growth in the non-individual housing loan segment is showing a decent growth, and the share of the total business, the non-individual housing loan, has grown. Number two, we are also looking at inorganic growth through direct assignment and lending. Policy is being formalized. I think very shortly we should have the policy in place and look at exploiting this organic route of direct assignment and co-lending to not only grow the book, but also give us a better margins.
Right. So, Mr. Adhikari, profit was supported by provision reversals from accounts sold to ARCs. Now, excluding this benefit, how should one assess the underlying earnings trajectory?
This is a part, right? See, our let us say our provisions are a basic part of profits. Over the years, if you've seen, our asset quality has been improving, and we see a lot more traction happening in the coming days. This year, this quarter also, there has been one big asset sale to an asset reconstruction company of about 140 crores. Right, which has added to the profit naturally, because the provisioning requirement that has gone off the books, the provisioning requirements have gone. And overall, the asset quality is improving. If I look at my the collection efficiency of the EMIs which are due every month has been improving. It is better than what it was during Q1 of last year, also during the whole of last year. So there is improvement in that. The recovery process is going on fine. If you see my stage 1, Stage 2, both have declined. There's a decline in both stage 1 and stage 2. Stage 3, the decline has been slightly nominal, only 14 crores if I talk of it. But then stage 3 is basically the legacy book plus what gets translated into NPAs during the course of the year. The legacy book, we have a large number of big loans which are in very advanced stages of resolution. And I feel in the coming days, probably the coming quarters, quarter 2, quarter 3, you are going to see a lot of traction in the legacy NPAs being resolved, and which will further add to the to a better asset quality, a drop in the GNPAs, definitely an increase in profits.
All right, as you mentioned about asset quality and its improving stance, so we should maintain this trend to sustain further as well?
Definitely, definitely.
Any more accounts you are looking to sell, ARCs?
Well, yes, we do have an asset reconstruction policy in place, and we are trying to build up pools of NPAs which we can offload as pool instead of offloading single accounts or single large accounts. Of course, large accounts we will be tackling them on a one-to-one basis. We will not be offloading pools of large accounts. But yes, we are looking at offloading pools of NPAs to asset reconstruction companies in the near future.
Right, so operating expenses were higher than expected. Now that's led to a weak PPOP. Were these costs largely one-offs, or should investors expect an elevated cost base moving forward from here?
No, I think it was a one-off. 22 crores of OPEX was one-off on account of gratuity liabilities towards the employees. So this is, otherwise I feel our OPEX are completely under control. Our cost to income ratio has come down. So there is nothing to worry on that front. And I feel this one-off event of 22 crores is over and taken care of. Future provisionings are towards gratuity, provident fund and other liabilities happening on a month-to-month basis.
All right, with the competitive intensity from PSU and private banks in the housing loan space, how much pricing power do you realistically have on incremental disbursements?
Talking of competition, not only am I sensing anything, I believe I'm drowning in competition, right, from the public sector PSU bank space. They have an inherent advantage of at least 250 basis points lower cost of borrowing, right? Their cost of borrowing, I presume, is somewhere around about 5%, whereas my average cost of borrowing is 7.5%. So right from day one, they are 250 basis points ahead of me, and so naturally they have the ability to take calls at very low and competitive rates of interest, which they are doing. There is a lot of focus from the PSU banks, especially on lending in the retail housing sector, as well as the wholesale book also. So definitely this competition is there, and there is nothing we can do about it. Being the biggest housing finance company, we have to be in competition, especially keeping in mind that our segment, the segment we operate in, is almost congruous with what banks are operating in, mostly salaried class and individual home loan customers. So competition is something which we have to manage. Of course, we need to be careful as to how deep are we willing to compete, how low are we willing to bring our new loan lending rates to. We are conscious of that. We do keep on reviewing. And if required, we would be, right now what we are witnessing in Q1, our borrowing costs are going up. Loans are no longer available as cheaply as they were during Q3 and Q4 of last year. In view of the rise in borrowing costs, we'll take a review of our lending costs, especially in the new loan book segment, and try to ensure that we maintain our margins and our margins do not slip because of our, I would say, increased focus on staying with the competition.
All right, and the ROA guidance of 1.75 to 1.8% for FY27. So what will be the key levers for that one?
ROA, I believe, yes, our guidance was 1.75 I think 1.7, 1.7 onwards. Right now we are at, for Q1, we are at 1.85. You see on a year-to-year basis, there is an improvement of 9 basis points in the ROA. So we are going to keep this in focus. ROA and ROE will be in focus, and we are sure that we will be achieving the guided whatever guidelines or guidance we have given at the beginning of the year.
All right, Mr. Adhikari, thank you so much for taking your time out and speaking to ET Now. Thank you so much. And with that, it's time for a short break, but you don't go anywhere. More management's coming up, talking on their earnings, and also coming up more stocks.